If I had to invest around the SpaceX market launch today from scratch, knowing what I know about Starship, Starlink, custom AI chips, and the semiconductor bottlenecks nobody notices until they become expensive, I would not start with the question everybody is asking. I would not ask, how do I buy SpaceX? That is too obvious. I would ask, what has to get built, bought, manufactured, packaged, powered, and shipped before SpaceX can become the monster public company everyone is imagining? Because that is where the real opportunity usually hides. Not in the headline, not in the hype, not in the rocket video that makes everyone feel like the future just arrived. The money often shows up first in the plumbing, and right now the plumbing is chips. Today is Saturday, May 2nd, New York time, so comment below what day and date you're watching from. And if you value this kind of work, support the channel by subscribing and comment John AG Best below. It lets me know you want research, not recycled market noise. So in this video, we are going to walk through 5 stock angles tied to this SpaceX moment, not because they are guaranteed winners, nothing is, but because each one sits in a different part of the machine that could benefit if SpaceX, Starlink, robotics, autonomous systems, and agentic AI keep pulling the same supply chain tighter and tighter. And by the end, you will see why this is not just a space story anymore. It is a chip story, it is an AI infrastructure story, and weirdly enough, it is a packaging story. So let's get started. The first thing you have to understand is that SpaceX is no longer just a launch company. For most people, the mental picture is simple. Rocket goes up, satellite goes out, booster comes back, everyone claps, the internet posts a slow motion clip, and that is the business. But that is only the surface. The deeper story is Starlink. Starlink turns SpaceX from a company that sells missions into a company that can sell connectivity. That means recurring revenue. It means subscribers. It means a global network. And markets love recurring revenue because it feels more predictable than one launch contract at a time. Based on recently reviewed public reporting, SpaceX has already spent well over $10 billion developing Starship. And the reason matters. Starship is not just a bigger rocket. It is the system that could launch larger Starlink satellites, lower cost per satellite, and support the kind of scale Falcon 9 alone cannot handle forever. That is the part investors need to focus on. Falcon 9 made reuse real. Starship is supposed to make reuse industrial. But here is the catch. Starship is still hard. The company still has to solve repeated re-entry, ground infrastructure, fueling, launch cadence, and the whole messy reality of turning a giant experimental rocket into something that behaves more like transportation than fireworks. So yes, the upside is massive. But the execution risk is also real, and this is where the first big lesson comes in. A great company can still become a dangerous investment if the valuation assumes nothing ever goes wrong. That is why I do not like blind hype. I like the supply chain. Because while people fight over the SpaceX valuation, the suppliers may already be showing you where the pressure is building. Now, SpaceX has been launching at a pace that is almost ridiculous compared with traditional space companies. From recent launch updates, it had already completed around 50 missions this year by late April, and more than 4 out of 5 were Starlink missions. That tells you the real engine here is not prestige. It is deployment. More satellites, more coverage, more capacity, more data, and eventually more pressure on everything that helps automate, route, process, and manage that network. That brings us to the Superchip angle. The chip being discussed across Elon's ecosystem is AI-5. Now, we need to be careful here. AI-5 is not some magic SpaceX stock ticker hiding under a rock. It is part of a broader custom silicon strategy, especially around autonomous driving, robotics, inference, and maybe future data center use. But the important point is this. When a company wants to control more of its own intelligence layer, it usually needs more control over chips. And that sends money into the semiconductor value chain. Now, one more thing before we touch the stock list. Be careful with the merger rumor language around XAI and SpaceX. In a market like this, one phrase can become a whole investment thesis before anyone has actually read the documents. If formal filings confirm a structure, then we can analyze it. Until then, I would treat the XAI connection as a clue about strategy, not as a clean financial fact. Why? Because AI labs burn cash, rockets burn cash, satellites burn cash, data centers burn cash. If you combine all those dreams into one narrative, it can sound unstoppable, but it can also hide how much capital the system needs before profits show up. The market loves ambition, but it eventually asks for margins. That is why the suppliers are so important. They do not need to own the whole dream. They just need the dreamers to keep ordering parts. Think about it like this. If Starship scales, it needs avionics, software, sensors, communications hardware, satellites, ground terminals, and compute. If Starlink scales, it needs more satellites, more network management, more user demand, and more launch capacity. If Tesla robotics and autonomous driving scale, they need inference chips, training compute, and manufacturing partners. If enterprise AI scales, it needs cloud infrastructure. Different stories, same bottleneck, compute. And that is why these 5 names matter. Stock number 1 is TSMC. This is the toll road. A lot of companies can design chips. Far fewer can manufacture the most advanced ones at scale. That is why TSMC sits in such a powerful position. If Nvidia wants advanced chips, TSMC matters. If AMD wants advanced chips, TSMC matters. If custom AI chips keep expanding, TSMC matters. According to the latest company numbers, TSMC's recent quarterly revenue was in the mid-30 billions in US dollars, up around 40% from the year before. That is not normal growth for a company already that large. That is AI demand showing up in the income statement. And it is not just one customer, it is the whole demand stack. Data centers, accelerators, high-performance computing, advanced nodes, advanced packaging. The factory floor is becoming the battlefield. Now the risk is that everyone already knows TSMC is elite. You are not discovering a secret here. You are buying a world-class company that the market already respects. So the question is price, not quality. But if SpaceX, Tesla, robotics, and cloud AI all keep demanding more custom silicon, TSMC remains one of the cleanest ways to own the manufacturing layer. Stock number 2 is Intel. And I know, Intel has burned people for years. It missed waves. It lost credibility. It watched others become the stars of the AI trade. So when people hear Intel come back, they roll their eyes. Fair. But markets do not pay you for being mad at history. They pay when the future starts changing faster than expectations. And right now, the CPU story is getting interesting again. The first AI wave was all about GPUs. Training giant models needed huge accelerator clusters, and Nvidia became the face of that era. But agentic AI is different. When AI stops being a chatbot and starts doing workflows, calling tools, checking files, scheduling tasks, moving data, and running business processes, the infrastructure balance changes. You still need GPUs. Of course you do. But you also need CPUs, networking, memory, storage, and orchestration. You need the whole system. Intel's latest quarter showed revenue in the low teens of billions, with management guiding higher for the next quarter. Recent market reports also pointed to stronger demand for Intel central processors from companies offering AI services. That is why the stock has been revalued so aggressively. But do not confuse a revaluation with a straight line. If a stock runs too far, too fast, it can pull back even when the story is true. That is not betrayal. That is gravity. So Intel is not the low-risk idea here. It is the comeback idea. If CPU demand really tightens because agentic AI needs more general compute, Intel finally has a reason to be taken seriously again. Stock number 3 is AMD. AMD is not just one thing. It has server CPUs, it has AI accelerators, it has client chips, it has relationships with hyperscalers and enterprise customers, and that makes it a flexible beneficiary of this next AI phase. Based on the latest reported results, AMD's data center revenue recently reached a little over $5 billion in a quarter, up around 40% from the year before, driven by both ePYC processors and Instinct GPU shipments. That is important because it shows AMD is not only telling an AI story, it is selling into one. And as agentic AI moves from experiments to business workflows, more companies will need compute that is not only powerful, but available, cost-effective, and flexible. AMD can benefit from that, especially if customers want alternatives and second sources. But again, there is no free lunch. If the stock already prices in perfect execution, then even good results can disappoint. That is why I would not chase blindly after a big move. I would build a watch list, understand the setup, and wait for moments when fear gives you a better entry. Stock number 4 is Nvidia. Now, Nvidia is the hardest one emotionally because everyone has an opinion. Some people think it is unstoppable. Some people think it is the biggest bubble on Earth. I think both sides are a little too loud. Here is the reality. Nvidia is still the center of AI infrastructure. The latest company results showed quarterly revenue around the high 60s of billions, with data center revenue making up almost all of that growth. Full-year revenue was above $200 billion, up massively from the year before. That is not a meme. That is a cash machine. But the bigger the machine gets, the harder it is to shock investors. Nvidia can still be a fantastic company and still deliver more normal returns from here. Those two things can both be true. The bull case is simple. Hyperscalers are still spending enormous amounts on AI data centers. Recent market updates suggest the biggest cloud companies are on track to spend hundreds of billions this year on AI infrastructure. As long as that money keeps flowing, Nvidia has oxygen. The bear case is also simple. If those companies slow spending, if returns on AI investment look weaker, or if custom chips take more share than expected, the multiple can compress. So Nvidia is not dead. But it is not riskless. And that brings us to the fifth stock, the one most people skip because it sounds boring, Amkor technology. This is where we get into advanced packaging. A chip is not finished when the design is done. It is not finished when the wafer comes out of the fab. Modern AI chips increasingly depend on advanced packaging, where multiple pieces of silicon, memory, interconnects, substrates, and thermal systems are brought together so the final product can actually work. This used to be considered lower value, not anymore. Advanced packaging is becoming one of the biggest choke points in AI hardware. Even recent reporting on TSMC's Arizona plans pointed out that modern AI chips are often several chips combined through advanced packaging, and that this step has become a supply bottleneck for major AI players. That is why Amkor matters. Amkor has been expanding an advanced packaging and test campus in Arizona, with a planned investment measured in several billions. It also has a partnership with TSMC around advanced packaging and test services near TSMC's Arizona manufacturing footprint. That proximity is not just a map detail, it is a cycle time detail. The shorter the distance between advanced wafer manufacturing and advanced packaging, the smoother the supply chain can become. And in semiconductors, smoother supply chains are not cute, they are strategic. Now, Amkor is still not risk-free. Packaging can be cyclical, margins can move, customer timing matters, capacity has to be filled, and if the AI build-out cools, suppliers down the chain can feel it fast. But if packaging is the next bottleneck, Amkor becomes much more interesting than the average investor realizes. And this is exactly how AI cycles usually mature. First, the market pays for the obvious chips. Then it pays for the shelves those chips sit on. Then it pays for the memory next to them. Then it pays for the packaging, power, cooling, and testing that nobody wanted to discuss at the beginning. Boring becomes exciting the moment boring becomes scarce. So here's the full picture. SpaceX may be the headline, Starship may be the future platform. Starlink may be the recurring revenue engine. AI-5 may be the custom silicon clue. But the public market opportunity may spread across the companies that manufacture, power, process, and package the intelligence behind the system. The supply chain is where investors may find the receipts first. TSMC gives you manufacturing, Intel gives you the CPU comeback, AMD gives you flexible AI compute exposure, Nvidia gives you the accelerator king, Amkor gives you the advanced packaging bottleneck. And the real question is not, which one sounds coolest? The real question is, where is demand rising faster than supply, and where has the market not fully priced that in yet? That is the uncomfortable truth behind every infrastructure boom. That is how big themes create wealth. Not by chasing every shiny headline, by finding the pressure points. If you're successful, share your success story in the comments so others can stay motivated. And tell me this in the comments. Do you think the SpaceX public market moment will lift the whole chip supply chain? Or do you think investors are already getting carried away? Because honestly, both outcomes are possible. That is why I want you to stay balanced. Build a watch list. Study the numbers. Look at valuation. Watch capital spending from the big cloud companies. Watch Starship progress. Watch AI-5 manufacturing updates. Watch packaging capacity. Do not marry the hype. Track the evidence. And remember, this is for education and research only. I am sharing how I would think through the theme, not telling you what to buy or sell. Talk to a qualified advisor. Know your own risk. And never put money into a stock just because the story sounds futuristic. In markets, the future can be real and the entry price can still be terrible.